Thank you very much for joining us today for this discussion about our initial views on PR24 design. You'll remember we published our initial views on PR24 and future price reviews at the end of May. The paper outlined our 4 goals for PR24 and our high-level ideas for maximising the potential of price reviews to help the water sector create value. And you know, the purpose of this roundtable is to get your views on our consultation questions and to help us and the sector prepare for PR24. We will also aim to answer your questions. I think you may have not met some of my Ofwat colleagues on the call today. So to start, I will ask everyone in turn to provide a brief personal introduction. Following that, Aileen will take us through a high-level introduction to our ideas and how they support our ambitions for PR24 and future price reviews. And then the remainder of the time has been set aside to give you the opportunity to ask questions, to provide feedback on initial views. I'll facilitate that, and when we get to that section, could you please use either the raise hand function or post your question on Teams chat. So we'll aim to answer your questions or come back to to sort of discuss your feedback on our consultation question. So, right, quick round of personal introductions. I will start with my Ofwat colleagues first. So, Aileen.
Thanks, Jamie. Just before I do, good afternoon, everyone. Thank you very much for joining. Can I just a tiny bit of housekeeping? Can I just ask that everyone puts themselves on mute when they're not talking, because there's a lot of us on the call, just so that we can hear clearly. Sorry, I am Aileen Armstrong. I'm Senior Director across Company Performance and Price Reviews at Ofwat. I think I've met a few of the people on the call. Nice to meet the others that I haven't met before. I've been in Ofwat for a number of years, taking on the responsibility for the next price control just quite recently. I think, should we go to Juliet?
Hi, I'm Juliet Young. I'm a director working with Aileen on the price control. I had a considerable hand in the document that went out in May, creating tomorrow together, sorry, otherwise known as the May document. I've got specific responsibility for the incentives area of the price review. Some of my other colleagues who you'll be introduced to specialise more in other areas.
Great, thank you, Juliet. Will?
Good afternoon, everybody. My name is Will Godfrey. I've recently joined Ofwat from Ofcom, and I'm looking after the risk and return aspects of PR24. My apologies in advance if the connection is really bad. I'm afraid Virgin Media have let me down, so I'm on the mobile today.
Thanks, Will. Daniel.
Thanks, Jamie. Yeah, I'm Daniel Mitchell. I'm a principal economist in the PR24 cluster, working in the cost assessment team, focusing primarily on base cost assessment, but happy to answer questions on cost assessment related issues. I recently joined Ofwat last week and was previously at SEBA, working in the regulatory and competition economics practice.
Thanks, Daniel. We also have 2 colleagues from our communications team, Emma and Kirsty, which have been helping me sort of get this organised. So thanks to them as well. Just going through as I see on the participant list, Alessandro. Oh, I can't hear Alessandro. Let's come back. Alex? Alex Wheeler?
Hi, sorry, I didn't know if you meant me. Yeah, I'm Alex Wheeler. I'm an equity analyst at RBC, and I cover the listed water stocks amongst other companies.
Thank you. Alessandro Cantaruti? No, having problems with Alessandro. Andreas?
Hi, yes, can you hear me?
Yes.
My name is Andres, and I work for Covalis Capital. We're an equity investors in the water sector. So looking forward to this conversation. Thank you.
Thanks, Andreas. Chris Labour?
Yes, good afternoon. Chris Labert, Morgan Stanley, sell-side research covering the water companies as well as others across the utility space.
Thanks, Chris. Jonathan Constable.
Hi, Jonathan Constable, obviously. Credit analyst at Elgin, covering European utilities and infrastructure sectors. We're one of the biggest lenders in UK regulated utilities, if not the biggest lender.
Thanks, Jonathan. Beatrice.
Good afternoon, everyone. Beatrice de Ten from S&P Ratings. I'm the head of the utilities team.
Dominic Nash.
Hi, I'm Dominic Nash. I head up Barclays Equity Research in European Utilities.
Thanks, Dominic. And Maria.
Hi, everyone. I'm Maria Pasakova, Senior Director at Fitch Ratings, covering UK regulated utilities.
Hassan. I think you're on mute. Oh, no, you're off mute. You're on mute, I think, Hassan. Okay, let's move on to Jenny. Jenny Ping.
Hello, Jenny Ping here. I'm the co-head of Utils and Infrastructure, sell-side analyst at Citi, covering water, among others.
And Guy McKenzie.
Yeah, hi. I'm a listed infrastructure portfolio manager at BlackRock, and I also have lead analytical coverage responsibilities for the European infrastructure space, which includes regulated utilities and UK water.
Martin Young.
Yeah, good afternoon to everybody. Martin Young. I cover the UK utilities and waste space at Investec as an equity analyst on the sell side.
Thanks, Martin. Peter Hyde.
Hi, yeah, I'm a listed infrastructure expert at Atlas Infrastructure. We cover global listed infrastructure assets, including UK water, and I suppose I lead on UK water.
Thanks, Peter. David Sturton.
Hello there, David Sturton. I am a Vice President at IFM Investors, and we are a shareholder in Anglian Water Group.
Thanks, David. Verity.
Hello, everyone. I'm a sell-side analyst at HSBC, and I cover utilities with some specialisation in water.
Thanks, Verity. Sharon.
Good afternoon, everyone. I'm Sharon Veaton from Columbia Threadneedle Investments, buy-side fixed income research analyst. I'm covering the UK utilities, European utilities and infrastructure, looking at UK water since PR04.
Nice one. And Stephanie.
Yeah, hi, Stephanie Felds, a lead analyst for UK water at Moody's, and kind of generally responsible for regulated utilities and information.
And I think the only two people we were struggling to hear from was Hassan, are you able to just introduce yourself, Hassan?
Yep. Hi, good afternoon. This is Hassan Doza. I'm a buy-side investment analyst following global utilities at Water Asset Management, and also have been following the sector since PR04.
Nice one. Thanks, Hassan. I think we've lost Alessandro. So, okay, thank you for those introductions. So I'll hand over to Aileen.
Thanks, Jamie, and yeah, thanks for all the intros. Look, I won't spend very long. I just wanted to take one step back and give a little bit of context. Emma, if you're able to just click on to the next slide for me, thank you. Really, just to highlight what we have said in the document, but basically the core background to this. We have recognised that for PR24 and the price controls beyond PR24, that we really need to be addressing, key interrelated challenges, the challenges of climate change and ensuring that there's sufficient biodiversity, the challenge of, customers' interests and expectations rising and changing over time, and also the need to ensure that that this is affordable for customers now and into the future. So that's really the backdrop, and against that we've set proposed four key goals really for the work for this price review, and making sure that it's a foundation for future price reviews. And the focus points that we've pulled out are there on the slide in terms of four key aims really: to ensure that there's a focus on the long term, to make sure that we have a really targeted and full understanding of customers and communities, to ensure that we're delivering greater environmental and social value, and really driving improvements through efficiency and innovation. So those are our kind of guiding points. And I'm sure we will get into the ideas that we've got in the document to really deliver those key aims. Happy to explore more and explore questions, and we'd really love to hear your views on any ideas as well. But before we go into that, I also just wanted to flag really that in terms of how we do the price review, Emma, I'm still on the last one if you want to stay back, but before we do when we do the price review, we understand that we are looking to balance a number of key issues in terms of the way we actually conduct the price review and how it works. And as the goals kind of really underpin, the focus on the long term is incredibly important, and PR24 really being a staging post, if you like, a 5-year staging post in having to deliver what needs to be delivered over the next 30 years. So we've got some issues that we need to balance, and I think there are, as we go through the review process, we want to make sure that we're ensuring that there is great clarity about how the controls work, how we will set the price control, but also to ensure that there is sufficient adaptability for meeting those long-term aims. And the second element that we're thinking of in terms of balance is that we do pick up the challenge in terms of people wanting us to simplify the price review, and we're absolutely looking at that. I think it's just also about pulling out that simplification is not an end in itself or a goal in itself, where data or other things enable us to more clearly target what we're doing, and there's a level of sophistication that some might see as complexity. Actually, we need to get the right balance there. And the last one that I pull out is really just the point here that we need to ensure that there's the right level of comparability of the information across companies, but we also absolutely acknowledge, the need to reflect the, different sentiments and positions of, different regional areas. So those were just, some of the kind of principles that we're thinking of as we're working through this process. And Emma, sorry, if you want to flick on to the next slide, because I did just want to remind people of, we've put this in the document to really just show the timetable that we're working to, and we hope that's helpful. We're obviously still in the peach, but where we're looking to use this year now in the run up to the draft methodology next summer is that the May document really did put out a number of ideas in the context of those high level goals that we're really keen to get conversation on, further ideas and develop in order to get us through to honing the draft methodology this time next year. That was all I was going to say by way of intro. I think we're really keen to hear reactions or pick up any questions. Thank you.
Thanks, Aileen.
Emma, do you want to? Oh, sorry, I'll leave it with Jamie.
No, that's fine. We were just going to really try and give people a chance to ask questions and respond to the consultation questions. I think the raise hand is quite a good way if you could use that, and I'll sort of come to you in turn. Clearly, if you've got sort of questions, you can always sort of send them through as well. If you can put them in chat, I'm not sure everyone can access chat. I know Dominic, I was just seeing Dominic was on and then off the chat, so I'm just a little bit wary on that. But we can certainly, you can email me direct if you want a question, and I'll put it to the team. But I think let's start with the sort of raise hand function. I can see Peter, you have a comment, so let's come to you.
Well, I thought I'd start off with quite an easy one. Obviously, right at the heart of this is how much you look at the longer term. And so as a sort of slight easy way into this, we and I Atlas would definitely encourage you to look at much longer term than perhaps you have before. And so I'd be interested in sort of just exploring that in a bit more detail. I suppose it's a statement and a question, which is, on page 35 of the document, I almost think you've got it the wrong way round when you say we see the long-term strategies being developed as part and parcel of the 5-year business plan. I'd almost say it the other way round, which is surely you should be thinking about where the sector needs to be in, let's call it the longer term. I mean, let's call it 2050, doesn't matter what the date is. And you should be looking at, let's say, the 25-year water resource management plans, the wastewater management plans, and then working backwards and saying, well, what do we need to do every 5 years to get there? And we all know that things are going to change because quite clearly no one's got a crystal ball. But I think from where I sit, I'd be very encouraging to basically sit there and say we should see the 5 years within a 20-year framework, and really encourage you to sit there and say, well, okay, there's that. And if I could just ask one specific question, which is, have you thought about possibly thinking about TOTEX setting for, let's say, 10 years or at least 5 years plus an indicative 5 years, so that we kind of, I don't want to get on to bills, but so that we kind of frame, let's say, the next 5 years into a 10-year time horizon. And I don't want to get too aside, but obviously lots of, let's say, European electricity companies look at 10-year development plans rather than, let's call it, a 5-year development plan.
Aileen, do you want to start with a comment on?
Yeah, I was going to invite Juliet to kind of pick up those points, really. I mean, I think just on the general point, Peter, I mean, I think, what you have said, on the kind of positioning and thinking of, how the business plans relate to the long-term strategic plans. That is what we're saying. We're saying, look, it's got to be in that context. And I think, there's an element here in terms of just trying to be really clear that, well, we will need to see that for this review. So that's the link with the business plans, rather than trying to imply that it's we certainly weren't implying that the business plan the 5 years then answers the 30 years. It's that it's got to be in the wider context. But Juliet, do you want to pick up the broader points? I think Juliet's not able to get off mute. I mean, I think to kind of pick up then sorry, Peter, you had particular. Are you able to speak?
I'm here. Sorry,
bless you.
my laptop is doing strange things today. So I totally agree with everything that Aileen said. That's exactly our intention, that the 5-year plan sits in the context of a long-term plan. So there may have been a bit of sloppy drafting or something, but that's exactly what we mean. On the longer term TOTEX setting, interesting point. It's not something that's mentioned in the document. I think our intention is to agree the long-term aim. So, for example, in the long-term strategy, if the strategy is, okay, first we do this scheme, then we do this other scheme with the aim of getting here in 20 years, then we sit down, we scrutinize that, we agree that that seems like a sensible strategy, so that come PR29, we've got a provisional agreement to fund that second lump of expenditure. Quite what those numbers are, I think, is very difficult to say now. I mean, estimating TOTEX is difficult. We don't know about inflation. We don't know about productivity, all those things. I think when it comes to actually putting a pound million figure on how much that scheme will cost, I think that's difficult to do, although it's an interesting idea. But the intention is certainly to agree provisionally that, at present, that seems like a sensible long-term strategy or not. And so in future price reviews come PR29, we've sort of got an idea that we would fund the second lump of expenditure, but not the pound million figure on it. Does that help?
Yeah, I mean, obviously I've got a lot more thoughts, but I don't want to hog all the questions. But yeah, I mean, as a starter, that's good. And I just feel that if you can somehow broadly think about what TOTEX might be, let's say in PR29, then, as I say, the other thing is bills, isn't it? And as I say, I won't get into that, but obviously affordability and, reasonableness of bills, maybe people are accepting of bills going up by CPI or 1% real or whatever the number is, which no doubt comes onto the whole segment about what consumers want and how much they're willing to pay.
Exactly, and we would expect those long-term plans to take account of affordability. So when we are sequencing investment, when companies sequence their investment, they're doing it thinking, well, we can't do everything now because come PR29, there's going to be a massive spike in bills. So, this is a way of sequencing things which seems affordable given what we know now. Obviously, there are scenarios, wealth might go up, wealth might go down, all sorts of things might happen, which might mean that what consumers consider affordable, the general strategy might change, but certainly that kind of sequencing of investment, it should be done with affordability in mind.
Okay, thanks.
I'd just add, that certainly from a PR19 perspective, one thing, because we've had long-term plans in place in terms of things like a water plan and asset health and so on. But one of the issues we had was it was just very hard to see the consistency, through to the business plan itself. So what we're trying to, sort of get better at and learn from is really, making sure there is that sort of consistency across the different planning, aspects, but very, very much that aim that you're talking about there, Peter. The other thing, and it came up in a discussion yesterday, was maybe sort of agreeing on some sort of, because part of these will have to be adaptive. The customer plays a big role, in many of the solutions, things like per capita consumption and fat going down drains and all that sort of stuff. And the more you can get the customer playing a part in the value chain, helps a lot. But I think therefore maybe some scenario planning and agreeing on working up at an earlier stage some of the scenarios. I know in the Ofgem side, the sort of ED2 is focused quite a lot on agreeing some scenarios and then business plans being sort of done on a consistent basis on some agreed scenarios. So yeah, there's some good ideas out there, and we're looking to learn, but you're bang on about sort of what we're trying to achieve. So Sharon, I can see you've got a raised hand.
Thank you, Jamie. Just a few topics or ideas to perhaps think about. One of the things, just coming on from that last point on just having a longer term plan, I think probably should go back to some sort of simplicity in the whole in the whole regulatory construct and the price control. And perhaps we might be becoming too prescriptive, and the documents to read are getting longer and longer, and I can't find what I'm looking for anymore. And perhaps balance that level of being prescriptive versus perhaps you're looking at the takeover code, a spirit of the code or spirit of the guidelines in terms of company behavior and what you want the licensees to achieve. Maybe perhaps a spirit of the code approach might be appropriate going forward. And the other thing is just talking about leverage. We talked about group leverage. You're looking at that, the sharing, the gearing sharing mechanism and how that didn't work during PR19. I just wonder if perhaps as a regulator, you probably may not, rather than doing that, perhaps you should use the ring fence more. Maybe is the ring fence not being used enough? I mean, maybe look at that in terms of looking at levels of leverage at the junior level, overall group debt if it's going above a particular net debt to RAV or net debt to EBITDA maybe, or even dropping below a particular rating level. Do you then start to look at that and start to think, okay, now we'll tighten the ring fence at the OpCo level when these things are happening above the OpCo level? You may perhaps use the ring fence more often. And then because this is supposed to be an investable sector. It's these are key critical infrastructure assets. Having that strong BBB+ rating is absolutely critical for a lot of sterling funds. So that's quite important to us. And then finally, with all this, I appreciate PR19. It was very noisy, a lot of political interference there. So there was a lot of dodging you guys had to do as well around actually looking after the water companies. But how do you future-proof the sector from political interference, nationalization, and regulatory independence? Now, I know that politicians can't interfere in the final tariffs, but there was certainly plenty of political noise. So how do you preserve the sector and yourselves as regulator from that going forward? I think maybe, I don't know whether simplicity perhaps is the answer to that. Just a few ideas.
Maybe with your last point, I think probably Aileen, and then I might come to Will on the leverage and sort of gearing, sharing, and perhaps I think Juliet on the sort of simplicity and too prescriptive. So Aileen.
Yeah, thank you. And I mean, I'm sure, my colleagues will come in with views, but thanks, Sharon. I think, really helpful to have all the thoughtful ideas in. And I think, I mean, you won't be surprised, I would rephrase your question slightly differently in terms of, genuinely, but quite genuinely, it's not my job to preserve me. But I do think in terms of the regime that we have, what this is so important for this review and into the future is to demonstrate that the sector is operating and delivering in the interests of customers and the environment. I think what we are seeing, and I wouldn't call it political with a big P, but political small p, or society or whatever, the sentiment about what needs to be delivered for the environment, and the sentiment about how water companies behave, I think does come from customers, you know, as they're wider players, you know, in society. So we do need to take account of that. I make no apologies for trying to take account of that. But I think, you know, the way that the whole sector, include ours and the companies and all the play, you know, hugely important role for investors and other stakeholders, is really about demonstrating that we have a regime that really does meet the challenges ahead. And if a regime's working, I would have thought that's, you know, one of the best things for maintaining a regime. So that's just a kind of headline remark. I do think there is something in the, you know, the simplicity point in terms of that narrative as much as anything. But I'm sure Juliet will pick up kind of, you know, where we see that actually there are probably some things that people don't worry about. They might be quite complicated if you have to run them through a model, but actually maybe no one needs to see them. But, you know, I'll let Juliet speak as well on that, but I think they are a bit linked.
Yeah.
Juliet, we come to you. Yeah.
Sure. Yeah. The question of it's a bit what Aileen was touching on right at the beginning when she was talking about simplicity versus sophistication. I mean, I think some things are necessarily sophisticated and it's worth the effort. Like, I don't think anyone would like us to set the WACC on a very simplistic basis. Yeah, those are things where it's worth the effort, even though not everyone can follow the discussion about CAPM models and things like that. But in other areas, I think we can simplify, useful, or streamline maybe better. And that's particularly in the outcomes area, which I think is very, very complicated.
Outcomes, exactly. Yeah.
And the sort of cost benefit of additional bits of complexity might not quite stack up because it detracts attention from other areas. So we are, and the document we say we're proposing to streamline the whole outcomes approach and focus on common PCs, which cover the things that matter to customers and the environment, and have fewer bespoke PCs, for example, and also other complicated mechanisms like how we set ODI rates, which I have to constantly remind myself of because it's really quite complicated. So there we are, trying to do a lot of simplification. And your point about code, so for assurance of customer engagement, so the CCG area, we are proposing that we put out some simple principles and leave companies to decide how to actually implement that. That's quite a controversial proposal. A lot of companies would like us to tell them exactly how to do it. So there are differences of views on that, but there are areas we can simplify. I wasn't sure if you were thinking that the long-term aspect was introducing complexity, which was perhaps unwarranted, because I think that's, you know, it does in a sense asking for the long-term. We're not calling them long-term plans, long-term context. Because what we're not saying is specify exactly what you're going to do for the next 25 years. The long-term context, that does in a sense add a layer of complexity, but I think we feel that's an area where greater complexity or sophistication is warranted.
I think perhaps there's a link between that longer term sort of context working properly and Aileen's other point about, you know, the best thing in terms of sort of future proofing is, you know, this form of regulation delivers. You know, this is a real challenge, you know, over the next 5 AMPs and so it's really important. I think, you know, there are certain things you have to do now. There's going to have to be a lot of adaptive and, you know, flexible approaches and so on. So, yeah, I think there is a nice link between there. Okay, Will, will you come in on the sort of gearing, sharing, leverage point?
Absolutely, thank you, Jamie. And can you hear me okay? Just checking the connection.
Yes. Yeah, we can hear you.
Yeah. Okay. So you know, obviously we're very open to sort of ideas around instruments to deliver on financial resilience. I think hopefully we're on the same page. I mean, it's very important to secure financial resilience. Gearing goes to part of that. It's not the only thing, as was revealed obviously with the discussions at the CMA on the subject of gearing outperformance specifically. But I think, you know, financial resilience around, you know, the operations and the infrastructure remain important to us. So we're keen to maintain those throughout PR24 and beyond. But as we outlined in the high-level document, that there will be further discussion paper on the subject of financial resilience. But at this point, we'd be very much interested in kind of the incentives, the levers that you think are important or appropriate to deliver on that objective of financial resilience for what is a very important sector. And I think this then plays into the last point that you're making about financial noise, which is, of course, the gearing out performance sharing mechanism was itself part of a broader package that was introduced following the work around back in balance in 2018. And so I think, so to this point of, if you like, the sort of the future proofing of the sector, we've all got a part to play, right? It's the companies, it's the investors, it's the regulator. So that's probably about as much as I would say, because I think Aileen and Juliet have covered the other points very well.
Thanks, Will.
Thank you.
Verity.
Yes, I just a question and an observation. I'm interested about indexing the allowed return on equity, but for me, that doesn't mean a substantial reduction in the risk, which is, I'm sure, something that Will is going to be focusing on. So just an observation there. And I also have a question about what do you mean by balance sheet data? And are we just talking about gearing, or are we talking about pensions or other? Can you just define what you mean by that? And index data in setting the cost of debt. What does the balance sheet mean? Not simply gearing, I suspect.
Okay, Will.
I'll take the first one first, which was the question of indexation of the equity returns. Yep, very open to views on that. It's been adopted in one sector, energy, not in others. I think we're very open to ideas as to whether this is desirable or not, and of course considerations as to the additional complexity it might or might not introduce and whether that is worth it. So we're very open to views on that question. The issue of the balance sheet data versus an index, I think there we were referring to obviously the basis on which we set the cost of debt. And if you like, the emphasis which is given to, shall we say, a composite index of, for example, A and BBB bonds more generally versus the emphasis on, for example, an aggregate or average picture of the cost of debt for the companies in the sector. And so it's about the balance between those two that we were describing, where, if you like, the CMA took if you like, shifted the emphasis from what Ofwat had previously done, where Ofwat had previously put more weight on the reference index of A and BBB bonds, whereas the CMA preferred to place more weight on the cost of debt of the company. So that's the point we were trying to describe in the document.
Okay, great, thank you. And I'm just quite interested in the main document, that the whole discussion about notional capital structure, and you say on the benchmarking that companies' inability to directly pass through their financing costs supports financing efficiency and discourages excessive risk taking. But we're then back to the question of, do you actually trust the companies to manage their own balance sheets effectively? And it looks as though you're still not comfortable, given the fact that you were introducing, albeit as you say, part of a package, the actual your idea of what is an optimal capital structure.
Sorry, can I reply to a question with a question? Is your question what's our view on the optimal capital structure, or was it a wider point? Sorry.
Well, it was just a wider point about risk in terms of, you're clearly not comfortable with higher gearing because you wanted to disincentivize companies gearing up, which has been taken away by the CMA. But to a certain extent, is it because you don't trust the companies to manage their own risk taking?
I think, obviously, the starting point has long been that the question of the financial structure is one for companies. But I think it's one where, as a regulator, we can't remain agnostic forever if it has wider implications. So insofar as, for example, choices around financing structure either lead to a lack of transparency around incentives, or alternatively potentially lead to risks being borne, if you like, beyond the investors or beyond the company, if they potentially are decisions around, for example, leverage that are perhaps predicated on the idea that there is greater protection because of the nature of the economic regulation of, monopoly water companies, then that's the kind of risk that starts to get us interested. And those are the drivers for looking at financial resilience. It's those wider externality points, but recognizing that obviously it's, companies are best placed in principle to be managing the company and obviously the financing choices. But it's one, as I say, which is one where we wouldn't just step back and leave it entirely to the companies where we see this elevated risk, which obviously was the discussion back in 2018 and throughout PR19. And I think in many respects, PR24 continues where that debate left off. I think it's not about the aims of securing greater financial resilience. It's perhaps around the instruments or the emphasis on the instruments that we use. But, we are very open to the kind of ideas and suggestions that you've got, which is obviously why we're here today.
Thanks, Will. I'd also just sort of chip in the very simple sort of comment that clearly you've got a view about a notional capital structure. Obviously, you can observe there have been reductions in that in recent price reviews, both at Ofgem and at Ofwat. And then and it is notional verity. I think you used the word optimal capital structure. That it is a notional capital structure. And it's the companies have been choosing. But then there are financial resilience issues. So there's sort of streams there. They have a link, but they're both important objectives in terms of the notional capital structure and companies choosing their own and taking the risk for a different structure. And then secondly, also delivering on the financial resilience objective. So I think it's Chris now.
Good afternoon. I hope you can all hear me okay. I guess I just wanted to open up a general discussion on indexation, and I guess there are some comments in the CMA's final determination last year that allude to credit metrics and using sort of credit worthiness as a sense check. Does that tie into your preference for, say, a nominal framework versus a real framework? And how are you thinking about that sort of line of thought? I know it's a very vague and very general question, but I hope you can get the gist of where I'm going.
Yeah, thanks, Chris. I think yes, the gist is there. Well, did you want to come in with a comment here?
Yeah, I'll attempt an answer, and if it's not what you're after, please do rephrase. So if your question is about the approach that we take to indexation of the RCV and the question as to whether it should be, partial RPI or CPI inflation indexation or full CPIH, if I could just check that was the basis of the question, then I'll sort of proceed to the rest of what I think the answer is.
Yeah, I'll jump in and say yes, but I'll also say, have you considered moving to a nominal framework? Do you see that as something that you would entertain? And I guess what's the internal view of the nominal versus real debate?
Setting a nominal return rather than setting a real return. Is that what you're saying, Chris?
Yep, absolutely. Yep.
I mean, look, I think always open to sort of ways of doing it differently. Obviously, there's always a translation from the current approach based on, real cost of capital, inflation indexation of the the asset base, and then the envelope of revenues being also subject to inflation adjustment. And of course, one can do it in a nominal world, or one can do it in a real world. Obviously, there is the long-standing approach of doing it in a real world. I mean, that's kind of hopefully reasonably well understood. Clearly, there can be issues around the timing of cash flows, for example, which I appreciate is a complexity that arises from the current approach. But you know, if there are good suggestions for taking a different approach, I think we're open to them. But I think we'd want to be convinced that there were material benefits. For example, you know, is there a material reduction in risk that translates to a better output?
Chris, were you? Does that cover what you were keen to discuss?
Yeah, it does very much. I guess it's the Will, your comment around the timing of cash flows and this discussion, which is more long term in nature as opposed to short term in nature, and how those two streams come together. And but I think I understand, Will, what you said, and I thank you very much for the comments, because they're very interesting.
Thanks, Chris. Maria.
Yes, we have been talking a lot about longer term views. And I wondered if there are any practical mechanisms that you are thinking about that may link the 5-year price controls with longer term goals for the environment, for the society, for the companies, etc. Have you maybe thought of rolling 5-year plans such that everyone, not only companies, everyone, investors as well, know what sort of TOTEX allowances, capital expenditures, etc., will happen in the next 5 years? Because so far for us, it looks a little bit, at the start of price control, we have visibility over 5 years, which is great. But towards the end of the price control, it also almost falls off the cliff, and there is big reset risk, which, yeah, I guess would be much more helpful to have that for at least 5-year visibility on a rolling basis. So that's question one. Question two is, I think there is mention in the document around sort of managing extreme out and underperformance. And there's been a lot of focus on sort of on TOTEX outperformance in particular, I think, over PR19. Are there any mechanisms that you favor there? And is there anything that you would, I don't know, maybe adopt from what Ofgem has adopted, such as RAMs, so return adjustment mechanisms, or is there anything else that you are thinking about at the moment? And thirdly, and that's, I guess, is quite dear to our heart, have you changed your view on the financeability adjustments in terms of pay as you go, etc.? I.e., which, yeah, I think we keep viewing this as asking future customers to pay more for what needs to be done today, effectively. Thank you.
Okay. Thanks, Maria. Maybe in terms of the first question, Juliet, do you want to sort of talk through that? Because there's quite a lot we've thought through there, particularly on the outcome side and the other areas. But
there's two strands to that long-term certainty thing. The first strand is what we were talking about right at the beginning, about companies developing their 5-year plans within a long-term context, so that everyone, including us, have visibility over where they're trying to get to. So that's, I would say, the company side. The flip of that side of the deal is that we provide greater certainty over how we will regulate in future price controls. So what we talk about, providing greater certainty over incentive rates, for example, so that companies know if they invest now, they'll get returns not just in the 5-year period, but also in the next 5-year periods, and they have some idea about what that might be. Does that help?
Yeah, on incentive rates certainly helps, but in terms of TOTEX, do you have any
Which was a bit Peter's question about whether we can provide more certainty over TOTEX, and I won't repeat the answer, but I think we sort of I think it's quite interesting question, not one that we mention in the document. Maybe something to explore, but our idea is much more about providing clarity over what needs to be done.
I guess the question is, would you be considering providing that clarity on a 5-year rolling basis rather than 5 years?
I see. So we sort of
regulatory. Yeah, I mean, so we know, we as rating agencies, for example, or, investors as well, know on a rolling basis, the TOTEX that will be approved or, broadly approved for the companies to spend.
Maybe, do you want me to?
Yeah, sure.
So I think doing cost assessment in a price control is enormously resource intensive. To trying to do that on a rolling basis would probably be very challenging, would add quite a lot of complexity. But as an industry, we have quite good sight of how allowances have changed over the course of time. So that in itself gives quite a lot of certainty around what the future holds, because there's unlikely to be a massive disparity between two sets of periods where you wouldn't expect. So you might so that provides some clarity. But we are currently going through the cost assessment work group process with companies. And one of the things we're trying to do is to explore how we can build in that long-term view into setting cost allowances, because setting cost allowances 5 years ahead is challenging enough. So going beyond that is even more so. But we are exploring with companies on how we can possibly do that in a better way at PR24. So any views you have, more than welcome to consider them as part of the consultation process.
Thanks, Daniel. Will, would you maybe come in and just pick up the point about the sort of managing extreme outcomes in terms of outperformance and underperformance? I think Sharon sort of mentioned the return adjustment mechanism that Ofgem look at, a sort of cap and collar type, or varying incentive rates on sort of cost sharing at different levels. Whether there's sort of anything we're thinking about or open to there. And then there was the bit about the change on our view on sort of financeability adjustment, the sort of use of pay as you go to sort of, bring forward cash flow to solve the financeability issue, and how we're reflecting on that.
Yeah, so perhaps I'll take the last one first. I think the sort of fairly established approach to delivering on, if you like, financeability or reprofiling, if that was required in order to satisfy a particular view on credit metrics. We're keen to ensure that, if you like, that there is an approach to that means that customers, current customers are not disadvantaged vis-a-vis future customers, and of course vice versa. There's a balance to be struck there. Insofar as often today's customers are going to be there in the future, there's an advantage to that being NPV or net present value neutral, which is of course what used to be the ambition around using the pay-as-you-go, for example, and RCV runoff levers. Once you start getting into alternative approaches, then you do have to sort of just step back and say, am I hitting sort of, my best central estimate of, for example, the appropriate rate of return or other measures within the price control. So I think we're open to ideas as to how one approaches making those reprofiling adjustments to secure financeability. And in relation to sort of the package of sort of risk and managing sort of outlier outcomes, and I might sort of perhaps invite Juliet to come in on some of the specifics if you're interested, that we're thinking about perhaps around outcomes. But I think broadly speaking, if you take a step back, in principle, a price control should just be set for 5 years, and then kind of you let it run, and then maybe you have true ups at the end, but you let it run. In some sense, you take your best view, and I think there is a good case for some of these adjustment mechanisms, particularly in dealing with events that are most outside of management control. And we've already got a number of, for example, reconciliation mechanisms within the control. We do have certain caps and collars already, and I think this then goes back to the point around the complexity of the regime, which is, I think one can, each and every addition to the regime often is perhaps well-founded in and of itself. But I think the more that you layer in additional error correction mechanisms or adjustments, I think the more you move away from the principle of price cap regulation, and you end up getting a lot closer to annual determinations. But I don't know if there's more on, for example, what we're considering around outcomes, Juliet, that you might want to come in on.
Sorry, struggling with the mute button. I'm not sure. Do you have questions specifically about outcomes?
I'd be keen to move on if we can. I can see we're getting close. We're getting close to the scheduled end. So fine if understand people have to drop off. Perhaps we could maybe extend by 5 minutes, because I can see a couple of raised hands that we haven't come to yet. Obviously, very happy to take sort of further questions and consultation feedback following the meeting, and you can send that through to me. But if that's okay, then I'll come to, I think, Alex, you haven't commented, asked a question or commented so far.
Yeah, thanks. I'm just interested really in how you're thinking about achieving net zero versus affordability. The views of the consumer and how amenable they are to bill rises is clearly something that's important to consider. But then equally, if the regulator doesn't force some of that net zero capex through, could you find some service areas get left behind others, given the income disparities between the different service areas? I suppose I'm really trying to understand whether you'd compromise net zero spend to keep the pressure off bills.
Aileen?
Yeah, thank you. So I think it's about really kind of understanding that pathway through to the long-term aim, and I think I think there's a lot of space there to understand that I'm sure companies are going to have to do things very differently to really meet that net zero objective. So I think there is some uncertainty actually about what the costs associated are with that I think what we're really keen to do is make sure that we have a process that's going to enable that understanding of the steps that are going to be needed, and a real understanding of, okay, what steps need to be taken now, how can that be managed, and really move forward that way. So I think it's not about trading one off against the other. I think it's kind of clear that net zero needs to be attained now. We're going to learn more as we go through, so we do need to work together to get that clarity of what's needed now.
Thanks, Aileen. And I'll try and handle one question from Jenny and one from Guy, and then we'll close it. So Jenny.
Hello. Yes, just one on competition. Ofgem and Ofwat seems to be eternally going for competitive auctions of various things in order to make it palatable for consumers. Just wondering where you are on that process, and then circling back to where we started the conversation from right at the beginning. My one commentary around that is, when I first started the sector, we had one RAB, one return, and now we've got multiple RABs and at the moment one return. But when the competitive element starts to kick in at PR24, it's again the areas around simplicity and trying to make that palatable for the investor base.
Who would like to take that from the team?
I don't mind having a
So go on, Will, but yeah, let's have the conversation quickly.
Yeah, I mean, I think it's important to recognise competition's got a role to play. Those bits of the network or service delivery that can be exposed to competitive pressure, I think, should be. It's going to deliver a better outcome than regulation typically, but not always. The really difficult bit for any regulator, and having come from a telecoms background, this was always a juggling act, which was the scope to introduce competition in different parts of the supply chain whilst maintaining and not unduly fragmented approach to economic regulation of the bits of the network that were the entrenched monopoly bits. I think that is definitely a balancing act. But to your point about sort of reconciling this with an overly complex regime, then absolutely, I think that's something that's important, right? Which is you only want to open up the bits to competition where you think it's going to make a really big difference, and where there's a real prospect of competition delivering, obviously ultimately for consumers and the environmental outcomes that we'd like to see.
And then Guy, just one last quick question, and then we'll call it to a close.
Sure. Yeah, can I ask a partial follow-up on Jenny's question first and then ask a proper question? The partial follow-up is, do you see competition in business retail as a success? And does that have any implications for how much further you try to push competition in other parts of the value chain? But my actual question was also sort of competition related, just on direct procurement. There's a lot of discussion in the note on trying to make that more substantial. Substantial is not the word that you guys use, so I paraphrase. But just wondering, if you look at PR19, there wasn't that much. But if you were to implement the kind of measures, whether it's sort of reductions in the size of projects that could be eligible, for example, how substantial could that have been in PR19? I guess I'm trying to get a broad view in terms of how much more important direct procurement will be in PR 2024, or could be in 24 versus in the last review.
But just a personal view on DPC, I'd just say I think it does. It's very much case by case, but that you've got to have that separability, I think, is one of the key things. So it depends on the nature of the sort of projects. But I also, I really think I forwarded David's recent speech to you. I say I think the sort of large investment over the next 25 years is sort of almost a given. It's making sure it's the effective solutions at the right price, etc. But do remember, I think a number of the companies actually like this tool because they see it as a risk mitigation tool. That if you have got a lot of RCV growth and it's a very complicated long-term project, then you might see it as very, very beneficial for someone else to be the competitive asset provider. So that would be the comment on DPC. And I think your comment on business competition, I just say, and Will refer to this, is that, yes, never underestimate the competitive markets, require a heck of a lot of work as well as you see out there in terms of getting them to work effectively. And I think everyone's eyes open on that. And so shall we call it to a close maybe with a last comment from Aileen?
Look, thank you, and thank you for staying on the line. It's been hugely useful to get the perspectives, understand where everyone's coming from. If there are further thoughts, we would love to capture those, ping an email to Jamie, or we can always arrange some kind of follow-up. And also if there are questions, I'm conscious of this kind of format. If there are questions that you want to follow up with, we'd be happy to pick those up too. But I just really appreciate everyone's time. Thank you very much.